Good day, fellow investors. Verizon stock, we have discussed it a few times over the last few years. Now it's down 40% over the last year and a half, and we need to touch it to see how the dividend is going, what kind of risk and reward there is. By the way, on my research platform, it's free to check, so I'm just doing now the Italian stock market. Later I'll go to new countries, almost done there. S&P 500, Verizon is here on the list on the first document. And you can check also other 50 S&P 500 businesses that I did an analysis. I won't touch on all of them, make videos because simply no time for that. But quick insights into what I think can be found here. And you can also check my research platform here to see the covered stocks and what I do if you're interested in stock market research and my portfolios. So Verizon stock is down. Let's check the business. And the business, wireless, huge investments, huge capital expenditures that put pressure on cash flows now, but that should eventually revert. And that is exactly what the market is expecting. Net income going down a little bit, earnings per share, but then as the capital expenses for 5G subdue, then the company should increase earnings and also cash flows even more, lower debt, and should be a good investment over time. Their goal is to slowly grow ahead, make things more profitable, save a little bit, and perhaps the key here is cash flow, spending to decline 5 billion, so from the current 22 billion to 17. With that, they could lower debt. They have acquired a lot of debt because they paid the most money in the last C-band auction for 5G. And you can see AT&T spent 23 billion, T-Mobile 9.3 billion, and therefore their pile of debt has been going up, and this is a huge amount, 143 billion. But if you look at their free cash flows are operating profits minus capex, let's say. So if that capital expenditures that we have seen increasing in the past go back to normal levels and they start making profits, this could easily go to 20 billion again. And if that happens, that will be lowered a little bit every year. Things will look better, and it will be a better and better investment. But this is also an interest rate game, and interest rates are exactly what have hit Verizon stock over the last year and a half. Because if you look at the peak of Verizon in December 2020, that was coincidental with higher and higher interest rates from the Fed and in this case the Treasury. So when interest rates were lower, the stock was higher, holding, and you can see here in 2022, when the Fed pushed from 2% to the current 5%, this is the 5-year Treasury, I think, just for comparison, that's where Verizon crashed. Why did Verizon crash? Well, you take the dividend, because it is a dividend stock of $2.6, now the yield is 7%. Why is the yield 7%? Because if you look at here, when interest rates on treasuries are 0, then you're happy with 5% yield. That means 100 divided by 5 is 20, a stock price of 52. So we are here somewhere, 52. When interest rates went up, let's say to 4% for treasuries, then you say, okay, I'm not happy with 5%, I want a little bit more. 100 divided by 7 is 14, you multiply the same dividend that didn't change, and you get a stock price of 37.12. Now the price is 37.19 as I'm doing this video. So a very simple calculation. Verizon is seen as a dividend yielding bond, stable. It is likely that for the next foreseeable future, the business will remain there. And then there are these subtle things of lowering debt, lowering capex, allowing for more free cash flows that might do the change, but the key are interest rates. If treasuries go down, then Verizon stock will go up. That is the key driver here. And if you look at the yield curve, you can see an inverted yield curve. Short-term interest rates are higher, and everyone expects them to be lower in time. Therefore, there is more demand for these lower term bonds because the expectations are for lower rates in the future, and therefore people want to lock in these longer, higher rates when it is expected that the Fed lowers rates again. If this happens, then Verizon stock will go up a little bit, back to the 50s, maybe 60s, 5-6% dividend yield. If they can grow the dividend a little bit on that higher capex, then it might go again to 60 or something, which is 50-70% up, plus the 7% dividend yield that you are buying now, makes it an interesting risk and reward situation. However, when it comes to our YouTube portfolio, does Verizon fit it? There is positivity, but there is a lot of debt. It is an interest rate game, as that interest rate costs also hit the debt cost, therefore the cash flows or Verizon. So I would like such businesses without it being a macro interest rate game. I don't want to bet on macro, I don't want to bet on interest rates, I don't know what the Fed will do, I don't want to be in such an investing situation that I depend on the Fed. I don't like that. I have 5% dividend yields with 5-10% growth, irrelevant of the Fed, as we discussed with Amsterdam Commodities in a video recently. So that's just one example. The key is to see whether it fits you, and if it doesn't, if you want better, you can check my Amsterdam Commodities video and you can check my research platform. Thanks for watching, looking forward to your comments, and I'll see you in the next video.